Bitcoin just logged its 11th consecutive lower low, the longest losing streak since 2010. That's not market noise, that's a trend screaming that something bigger is happening. But why this happened is even more surprising, and the real consequence comes later. Start with the facts. On Friday, Bitcoin tumbled as much as 7.6% to about $80,553. Ether plummeted nearly 9%, dipping below $2,700. The total crypto market cap slipped under $3 trillion for the first time since April. In November alone, Bitcoin has lost roughly a quarter of its value, the steepest monthly fall since June 2022, when the Terra USD collapse set off a chain of failures in the industry. How did we get here? This isn't just a single bad day. It began with a massive clearing of leveraged bets on October 10th that wiped out about $19 billion in positions and erased roughly $1.5 trillion from crypto's total value. That shock forced a lot of paper sellers into real selling. In the last 24 hours, another $2 billion of leveraged positions were liquidated. And here's the twist. It's not only margin traders. A wallet labeled Owen Gunden, holding Bitcoin since 2011, started unloading $1.3 billion of coins in late October and finished divesting this week. When long-term holders sell, it signals a deeper shift in conviction. And it gets more complicated. Institutional flows have turned against the market. A group of 12 US-listed Bitcoin ETFs saw about $903 million in net outflows on a single Thursday, one of their largest redemptions since launching in January. Open interest in perpetual futures is down about 35% from October's peak. That combination, forced selling, large holder exits, and evaporating leverage, is what's dragged prices lower and turned sentiment to extreme fear, according to market gauges. A broader market backdrop hasn't helped. Stocks gave up gains as investors questioned stretched valuations and the timing of a Federal Reserve rate cut, and that nervousness reduced risk appetite across the board. Meanwhile, corporate strategies that mirrored Michael Saylor's Bitcoin hoarding are under pressure. Strategy Inc.'s MNAV, a measure of enterprise value relative to Bitcoin holdings, collapsed to just over 1.2, and analysts warn the company could lose inclusion in major indexes like the MSCI USA and NASDAQ 100, a decision due January 15th. Copycat firms have even been selling crypto to fund buybacks to prop up their own shares. So what's at stake? For retail investors, volatility means potential catastrophic losses if you're leveraged or poorly diversified. For companies with Bitcoin on their balance sheet, this downturn can translate into plunging stock prices, margin stress, and even delisting risk. For the broader market, a deeper crypto rout could sap investor confidence and spill into other risk assets. What should you do? First, don't panic sell on emotion, but also don't double down blindly. Check your leverage, stress test your liquidity needs, and consider dollar-cost averaging if you believe in the long-term thesis. If you're a business holding crypto, be transparent about risks and prepare contingency plans for index changes or margin shortfalls, and watch flows and liquidity. ETF redemptions and large wallet sales are the high-frequency signals to monitor. We're at an inflection point. This could be a cleansing reset that removes speculative excess, or it could reveal deeper structural fragilities in the market. The next few weeks of ETF flows, large holder behavior, and regulatory or corporate reactions will tell us which story wins. Either way, this isn't just a crypto story. It's a test of market psychology under pressure. And the outcome will matter for investors, companies, and the wider financial system.